Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No one is paying attention. It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Hi guys, welcome to the Greedy Trader channel. Well, I'm not exactly greedy, as most of you old watchers of the channel will testify. I have the most conservative approach to trading. It's just a nice parody idea from the Gordon Gekko mantra. There are only 2 kinds of traders, the greedy ones and the fearful ones.
Greed, for lack of a better word, is good. Greed is right. Greed works.
Those of you who are new to the channel, this is where you can learn how to really trade like a professional. Every video I make is packed with real examples with before and after scenarios, so you can see that it is simply a question of sticking with the plan, not changing it because you're having an emotional meltdown. Have you spent several months backtesting your trading strategy only to go live and then discover the strategy has fallen on its face? We've all been there. You're likely doing one of those 5 things I'm about to tell you. This video is a sequel to my video on how to backtest a strategy in 30 minutes. If you've not seen it, then you can watch that before you watch this one. I've linked it in the description below and the end card. Having spent more than 15 years as a trader, with 5 years of that in the professional trading arena, I genuinely understand the frustration that comes with developing a trading strategy does not work. By the way, I did a video on how to build a winning trading strategy from scratch, so check it out. So what are the 5 strategy red flags you need to know to stop your strategy falling on its face? Number 1, curve fitting. Curve fitting, it's natural for us as humans to see what we want to say. So when we look at charts, we see so many opportunities historically. The perfect setup show up everywhere. You folks know what I'm talking about. Here's an example. Take this fat tail bar. Let's say you're backtesting a sweep and reclaim strategy. I think ICT students will call this a manipulation candle. You can see on the 23rd of April at 9 AM, this bar swept the low of the previous bar and closed higher. You may consider buying. Okay, that trade reversed and stopped you out at the low of the manipulation, but that's not point. Take a look at the 24th of April. The same thing happened, but there's difference between the 2 scenarios. The difference is volatility. Both bars had different volatility ranges. This will not only cause you to over-optimize, but it does not account for live market behavior like slippage. So you need to forward test as opposed to just back test. Back testing is for optimization. A good quant will tell you this. Forward testing gives you real data based on real market conditions. I recall volatility disappearing for the pound in 2018 and returning in 2020. Not many strategies can survive volatility changing. Don't waste capital on a strategy derived solely from a backtest, especially if you have a small cap. Number 2, the time frame mismatch. I'm a believer that there is no right or wrong in trading. However, there is being unrealistic about your expectations on a trade. I've seen many traders take their cue to trade from a daily chart and then execute on a 5-minute chart to catch a trend on the higher time frame. This makes sense intuitively, but in practice will offer poor returns. Daily chart has nothing to do with the volatility in a 5-minute chart, so there is no guarantee that you can hold a trade in a 5-minute chart because there is a trend on the daily. It's a feel-good idea. Eventually, you'll end up making your chart look like this. What's the point of trading a 5-minute chart in that case? Instead, use 3x rule. Align your 5-minute chart with a 15-minute chart. The volatility will likely be similar and you'll still get the higher time frame confirmation. If you've ever used the TPO chart, then you'll understand this. By the way, if you have questions on TPO or market profile, join my Discord, link in the description below. In the world of trading, timing is everything. Gain the edge you need with Bookmap, the ultimate platform for real-time market visualization. Track the very pulse of the market with their liquidity heat map. Visualize historical and real-time order book data to spot opportunities as they emerge. Analyze buying and selling pressure with their customizable volume dots, giving you precise insights into the market behavior at every price level. Stay ahead with their advanced order book visualization. See the full picture, current and historical order flow at your fingertips. Monitor the market movers with their large lot tracker. Identify significant trades and follow the footsteps of major players. Unlock deeper analysis with powerful proprietary indicators like the imbalance indicator and ISO order detection, designed to give you the ultimate edge. Trade anywhere, anytime. Connect to leading global markets, including futures, stocks, and cryptocurrencies, all in one platform. Take control of your trades with an interface designed for efficiency. One-click trading, drag and drop order adjustments, and real-time updates keep you in command. See the market like never before. Gain clarity, confidence, and control with Bookmap. Start your free trial today and get up to $120 off yearly plans. Help support the channel and Bookmap by using the link in the description. Ignoring market context. I cover this in depth in my video on how to build a winning trading strategy, and it is mistake number 2 in my video, 3 deadly mistakes killing your trading strategy. Both are well worth a watch. I've linked to them in the description below. When developing a strategy, my first steps are usually to define the asset's character. Is it range bound or trending? I have a unique metric I use to determine this. You'll have to watch the videos I mentioned where I covered this step in detail. 90% of traders do not do this. They assume a strategy can be consistent for just being a strategy from a famous trader. Take ICT. I see this applied like it's a silver bullet in all markets. This cannot be the case, as the ICT strategy is highly reliant on a range-bound index, typically in bear markets with high volatility. This would have been an impossible system in 2019 to 2020, where volatility in the index was low and the index was very directional. Always check the volatility of the asset over time and make sure that this fits with your strategy. Not all assets are suitable for all strategies. Market context is hugely important. Don't ignore it. Number 4, static risk per trade. This is highly controversial for most traders. The fixed lot size industry has gone to everyone's head, losing all rhyme and reason. If you risk 2% on every trade and your account goes into drawdown, then you'll have some issues, especially if you say 2% of your starting balance. I'm an advocate of dividing the starting balance into say 20 trades or 40 trades, but I expect traders to be dynamic enough to adjust this based on the asset volatility on the day. For example, let's say you're running a range break strategy out of a 20 pip range with $200 risk, aka 2% of your account. This is pretty good. Let's say the next day you're doing the same, but this time volatility drops and the range narrows to 10 pips. If you increase your lot size to get the same $200 risk, you are guaranteed to lose money. That's because volatility is so low that the chances you'll get stopped out is very high. Instead, you could keep your lot size the same and risk $100 instead, reducing the risk in low volatility environments that have a more likely outcome to go bad. Equally, a very high volatility range will offer very low potential, so it may even be prudent to risk nothing at all. Sometimes it makes sense to adjust risk based on volatility. Number 5, profit factor blindness. 90% of traders are profit factor blind, so they put a huge focus on win rate and not how much they win in total. I can appreciate how complex this is because the profit factor is affected by commissions, slippage, and spreads. A trader needs to cover all these costs in the profit calculation. This is no small task. I cover this in my video, the 5-step blueprint to consistent trading. Again, I'll link this in the description below and the comments. The sweet spot I found after testing over 1,000 trades is a 60% win rate at a 1 to 2 to a 1 to 2.5 with about a 10% break even, leaving a 30% outright loss. This eventually creates a 1.8 to 2 profit factor, or for the absolute asymmetric risk traders, a 1 to 3.5 with a 30% win rate in an inflation edge asset. I go into depth on how to set this up in my video, How to Build a Winning Trading Strategy That Works. Make sure you watch this number closely. Prop firms now include this in their dashboard areas, and it is available on several broker platforms. If you got some value from this video, then you know what to do. I appreciate all of you. Till my next video, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?